Well, there's another rare dot ball from the RBA Board this month. Only the second time that they've chosen to actively pause in interest rate tightening that began in May last year. The government's decision statement sets out the reasoning more clearly, saying they were looking for additional time to assess how their 4 percentage point interest rate tightening was affecting things and the refresh of the economic outlook. The Governor's decision statement also warns, though, that further tightening may still be required. The next monthly meeting in August will follow important updates on CPI inflation, the June quarter update, which provides a much more thorough and clear information update around underlying inflation measures and the services components in particular. That'll be an important one leading into next month. We'll also get a refresh of the RBA's staff's forecast, the Statement of Monetary Policy for August, due out a few days later. All up, though, it does suggest that this is going to be a relatively brief pause. While Australia's mortgage bailout will be relieved at a month off rate hikes, the case for additional moves is still strong. We think that June quarter CPI update will again disappoint somewhat. While we've clearly seen the peak in inflation has passed in Australia, progress towards that 2 to 3% target is likely to disappoint again, and services inflation we suspect will continue to persist at too high a level for the RBA. Meanwhile, some of the other developments we've seen over the last month and prospectively over the next month will be of some concern. The labour market continues to hold up much better than anticipated. The flip side of that is we're not seeing the same sort of slack, the expected slack emerge around the labour market. The last update on jobs had a 76,000 gain, unemployment rate holding at 3.55%, still a full percentage point below where the RBA expects full employment is, a level at which would be consistent with sustained return to low inflation. Meanwhile, job vacancies are still very high. They ticked down for the May update, but are still over 430,000 nationally, not far below the 510,000 unemployed we're currently carrying. So labour market conditions are still very tight, and we're still seeing signs that of a lift in wage and price expectations. This week we saw an update on enterprise bargaining agreements passed in the first quarter of this year that's showing average wages lifting towards 4%, a 4% annual pace. Again, will be of some concern leading into the next meeting. As we've noted in the past, we've also seen a distinct shift in the priorities from the RBA Board. The emphasis is going more on inflation and ensuring we get a timely return to the 2 to 3% inflation target, and less so on preserving the gains that we've seen, particularly around the labour market. The lower unemployment rate compared to the pre-COVID levels, the RBA Board has been looking to retain as much as possible of that. And that was evident in the decision statement from the July meeting, where we saw the emphasis shifting around keeping the economy on an even keel, which was a line that appeared in June, in favour of just a pretty bland statement that the Board expected the economy to continue to grow. The focus is really shifting very clearly to that inflation threat, and the risk here that we see a more prolonged period of high inflation will be what we expect to see weigh on the RBA in the next couple of months. As I said, we see this as mainly a 1 month pause with a further 25 basis point tightening in August and a final move in September, beyond which we'll see a more sustained period of rates on hold, eventually giving way to rate cuts next year from around from May on. But until then, we've still got a few more meetings to go and a few more rate hikes to survive. That said, month-to-month decisions may still be quite finely balanced in the next couple of months. Also of interest in August, when we get that refresh on the RBA's forecasts, we're going to see some mix of a lower growth outlook and an increase to the wage growth outlook. How that translates to their expectations around unemployment and inflation are less clear, and they'll also be of great interest. The forecast will also be extended out to the end of 2025. So whether we see a full return to the midpoint of the 2 to 3% inflation target range will also be of interest. So July may well have been a dot ball for policy, but the next few meetings are well and truly live.